Good morning or good afternoon, wherever you're joining us from. Welcome to our July 2023 IFRS and Corporate Reporting webinar. It's our first webinar in the new financial year, and this time we're talking about the challenges of applying lease accounting practices. I know most of you will be working on your 30 June 2023 financial statements and might be in the midst of all the struggles around lease accounting. It really is the gift that keeps on giving. Every year we unpack more challenges. This standards already became IFRS 16, already became mandatory in Australia on 1 July 2019. So a number of years later, we're still dealing with so many issues around lease accounting. And there are some new issues as a result of the recent increases in interest rates that has a flow-on effect on lease accounting. So welcome to this webinar. We hope you enjoyed today's webinar. Now, as always, I have with me my partner from Sydney, Kevin Frohbus. Hello, Kevin.
Hello, Aletta. How are you? It's good to see you again. And I hear you in Brisbane today.
I'm in Brisbane. When I look outside, it's blue skies. It's beautiful. I'm speaking at a sustainability conference later this afternoon and then back to Melbourne. I have to say, last week, Kevin, I had the privilege of attending the BDO Global Sustainability Conference, which was held in Rome in Italy. Fantastic to share ideas with all the other sustainability experts, but can I tell you, it was hot. We're talking about 39 degrees every day. So I think it's the first time I was happy to come back to Melbourne in winter for the cooler weather. I also would like, or we would like to start by acknowledging the traditional owners of the land on which we meet today and pay our respects to elders past, present and emerging. And we also would like to extend that respect to Aboriginal and Torres Strait Islander peoples here today. So what will we cover? I've added the first two items because the last week of June was a really big week for sustainability reporting. Two really big events on Monday, the 26th of June and Tuesday, the 27th of June. And I would like to touch on that and briefly, and then we'll talk about lease accounting. And then I also want to focus on 30 June. Based on those two announcements, it has some follow-on effects for 30 June 2023. So I'll touch on that briefly, and then I'll hand over to Kevin to lead the discussion, our war stories around the top 10 lease accounting challenges that we've seen and that we're currently seeing. So the last week of June was really big, and we've been waiting for this for a long time. The International Sustainability Standards Board was established in November 2021 at COP26, and just over 18 months later, on the 26th of June, they've published their first two standards. So IFRS S1, which is the general requirements, and IFRS S2, the climate-related disclosures. Now, for many years, people have said around sustainability reporting, we have a problem, there's not a generally accepted framework. And that's now been addressed. So the ISSB have consolidated a number of previous standard setters into the ISSB. They've issued the very first two standards after extensive consultation. They're starting with climate-related disclosures being mandatory globally for years beginning on or after 1 January 2024, and then a year later, IFRS S1. They're already working on IFRS S3 biodiversity, S4 around human capital, S5 around supply chain. So we've got the two standards, which is exciting. But then a day later, Treasury, Australian government and the Treasury issued their second consultation paper. And my funny story about this is, this morning, on this Tuesday, I was doing a media interview with a journalist about the new IFRS S1 and S2. And the journalist asked me, so when would these standards become mandatory in Australia? I mean, there's a recommended mandatory date globally, but it's up to each jurisdiction. What do I think? And I said, listen, There was a consultation paper, a first one in December. I think Treasury have been waiting for the final standards, and we are expecting Treasury's final position or potentially a next round of consultation soon. And I put down the phone and I looked at my emails, and there was the Treasury consultation paper, the second one. So I immediately phoned the journalist back, and I know you never phone a journalist, but I phoned him back and I said, listen, by the way, that question you asked me, the consultation paper is open and is available, and here's a link. So it happened really fast. The Monday, the standards, and the Tuesday, Australian Treasury indicated what they would think. Now, there's three things that I want to highlight here because they're quite significant. The very first one is that initially they were talking about mandatory sustainability reporting for listed entities initially. They were thinking, well, we start with large listeds and then all listeds, but it was focused on listed entities, financial institutions. That was the initial thinking. And then ultimately phasing it in over 4 or 5 years to get to all entities preparing and lodging financials with ASIC to do mandatory sustainability reporting, specifically climate-related disclosure. So initially, all about listeds. In this second consultation paper, they completely abandoned that idea and said, we don't care whether you're a private company, whether you're a listed company, whether you're family-owned business, don't care. It's all about size, because often size is correlated to level of emissions. There's no position yet on public sector. They just flagged that the Minister of Finance is looking at that. And also not-for-profits. If not-for-profits are not lodging with ASIC, but not-for-profits are actually lodging with the ACNC, no guidance yet. However, if a not-for-profit is a company limited by a guarantee and they lodge financials with ASIC, they would be caught. So for not-for-profits, it's a weird place. Some would be caught and some not. Now, the size has created a big surprise, especially for private companies, because they thought they will be caught later. It's all about listed companies. So if you look at this, the proposed timeline now, there's 3 groups. Group 1 is 2024 and 25 onwards. So it's basically 31 December 24 if you're a December year end, and 25 is 30 June 25 if you've got a June year end. And they're saying, if you're required to report under Chapter 2M of the Corps Act and you fulfill 2 of the 3 thresholds, you first cap of the rank. So if you've got more than 500 employees, the value of consolidated gross assets more than $1 billion, consolidated revenue more than 500 million, then you first. And also, they also capture controlling corporations under the INGA Act. So you can see there's no issue, there's no statement that you are excluded because you're a private company. So a number of large private companies or large family-owned businesses, this is quite a shock because they have to do mandatory disclosures very soon, including carbon accounting, etc. The second group is, more than 250 employees, consolidated gross assets more than 500 million, consolidated revenue more than 200 million, and again, controlling corporation under the INGA Act. The other thing that's interesting here, this second group, they've got a little bit of time. So we're looking at 31 December 2026 or 30 June 2027. So this is a delayed timeline. Group 1, the big ones, go very soon, 24, 25. Then there's a 2-year gap before Group 2 joins. And then finally, all other entities that prepare and lodge financials with ASIC is 27, 28. So it's quite a delayed timeline. The surprise is around the private companies. Now, this could be good or bad news for our clients, depending on your position. If you're a private company, this could be bad news because you have to get ready very soon. If you're a small listed company, this is good news because initially you thought you'll have to report in 24, 25, and now based on size, it could even be pushed out to 27, 28. The other thing I want to say at this stage, this is mandatory reporting, and what we should not forget is that if you're in the supply chain of entities that have to do mandatory reporting, you will be caught because they'll reach out to you. They cannot reduce their carbon footprint if you as suppliers don't help them with scope 3. So we're not off the hook, but if we look at the strict mandatory requirements, starting with large entities and then going to the smaller entities. So a potential timeline, if you are in group 1, for the very large entities, you have to do mandatory reporting, let's say 30 June, if you've got a 30 June year end. From 1 July next year, you have to capture all the appropriate relevant information, and therefore really important to start as soon as possible. And remembering they will reach down to their supply chain to gather information.
Aletta,
yes,
Aletta, can I ask you a question? And this is going to be the nature of our presentation today. It's probably going back and forth between each other. A couple of questions I've already received. I know the answer, but I'll ask you for the benefit of our listeners. How have they dealt with financial institutions in this second consultation paper?
Yeah, so financial institutions, Kevin, the same as all entities, right? There's no distinction. I think financial institutions, again, if they're on that large end of the scale, they will be captured initially. But it's all about size. And Kevin, maybe there's two other things I should say. They've clarified who this applies to. But they've also, I mean, they're consulting, but this is their thinking at the moment. They've also indicated that limited assurance will be required and ultimately become full audit. But they've clarified who can provide that assurance and audit. And they've indicated that they believe financial auditors should be doing the work and that they should use the expertise of sustainability and ESG experts in the organization. So assurance will not be provided by sustainability people. Assurance will be provided by normal financial statement auditors, assisted by sustainability experts. And then the third thing, a lot of directors and entities have raised concerns that, you know, climate-related disclosures, scope 3, difficult to estimate, quite a bit of uncertainty. They're worried about that and that they'll have a liability as directors. There's also concerns about forward-looking statements. And therefore, the third big thing is that they're introducing a 3-year period starting next year, a 3-year period where AFIC can take action against entities, but directors will be protected against proceedings for 3 years, not 3 years from the year you start doing it, 3 years starting next year, the start of the regime. So there can't be civil proceedings against them if they've acted honestly in good faith and all of those things. So again, that's a kind of new angle. But Kevin, you had more questions.
That was it. That was it for now, just to get us going on financial institutions, okay, which were quite a focus of the first consultation paper.
Absolutely, and initially there was some thoughts that the mandatory reporting would go as low as small credit unions.
That's right.
So they've moved away from that, right? They're just looking at size. Now, the focus on 30 June, we talked about this previously, and that is, you know, the TCFD recommendations are still the best stepping stone to these new mandatory standards, IFRS S2, because IFRS S2 is just an expansion of the TCFD recommendations. You don't have to do everything, do a gap analysis, make a start. And then measuring your carbon footprint is critical as part of the TCFD recommendations, but also IFRS S2. So we don't waver on this. It's important to do this as soon as possible. So we've got the free TCFD training, the e-course, and we've got a checklist that you can download. On the greenhouse gas protocol, when we look at carbon footprint, we've got a publication and we've scheduled 6 webinars starting next week around measuring your carbon footprint. So we're trying to focus and help our clients on the 2 critical things they can do now to get ready for what's coming, and that's TCFD recommendations and measuring carbon footprint. If you're in that first group that have to report 24, 25, we definitely need to speak to you. There's a bit more to do and actually quite a lot to do. Kevin, at this stage, I'll hand over to you so we can come back to lease accounting.
Thank you, Aletta, and thank you for that introduction. I think it's important that we keep on top of sustainability, especially that Treasury moved so quickly locally once that paper came out. So it's really important that you keep an eye on that, because it's a governance issue in the sense that you need to start planning for this in the first instance, and a lot of organizations have, but obviously now it's starting to be a bit more certain. The segue, I guess, into lease accounting is twofold. One is we've come back to an old favorite, and as I want to say that this was always Aletta's, like, really, it was her key favorite one, but now she's got two favorites, sustainability and lease accounting. So now she's done both of her favorites in one webinar, lease accounting. But the other segue in this is lease accounting in many ways is a systems and process issue, which by itself is a governance issue, which is a sustainability issue. So there's your segue into lease accounting. Why have we circled back to it at this point? It's never gone away. And Aletta, she always talks about it being the gift that keeps on giving. And what we mean by that is it's a constant challenge for clients, and they're constantly looking
Yeah.
for advisory solutions and just systems and software solutions to assist with this. And the reason for that is because lease accounting in its purest form is not so much an accounting standard that needs to be complied with, but a system and a process that actually has to generate proper financial information, and it has to be managed and on a consistent basis. So I think the overall theme that I'd like to leave with you with today is the overall lease accounting challenge in 2023 still is consistently managing the data and information flow that feeds into the calculation, that feeds into the financial information for lease accounting. Now, it's a series of data and information flows, but I actually want to say to you that the challenge is actually to treat this as a project management system, or a system that needs project managing. Why do I say that? There's really three areas that feed into lease accounting. And the way we've structured this today is we will give you a whole bunch of war stories and examples, 10 of them, which will all demonstrate how those three things come together. And that's source of data, judgments, and specific specialists. Lease accounting is almost an art, a project management skill of bringing together data from different sources, judgments from management, and then the specialisms that come from lawyers, valuation experts, and IFRS specialists like myself and Aletta. Let's talk source quickly. Source of data is the source of data is property management systems and finance systems. So it's bringing data from property manager systems. What are the lease contracts? Who's negotiating the leases? What's going on in the lease portfolio? Plus cash flow information from the finance system. So there's a whole bunch of sources. That's got to be brought together with management intention and judgment. How long does management plan to be in a property, and do they plan to exercise options to determine lease terms? And then finally, it's interpreting all that data. You need lawyers sometimes to understand what the contract is and what the rights in contracts are. You need valuation experts, in particular around IBR, which is going to be my first topic off the rank. And you need the IFRS specialist to design a process that essentially aligns with the standard. And as you can see, the biggest challenge there is bringing all that together. So let's do some war stories. We're going to go through the top 10 challenges, because these are either the data, the specialisms, or the judgments that keep giving the challenges to our clients. We'll have some war stories. Let's start with incremental borrowing rate. Why? Because it's probably my favorite. Why? Because, as you know, impairment and valuations and anything that's got to do with the valuation and how it aligns with IFRS is my favorite topic. So we'll start with incremental borrowing rate. Why is this a challenge? Because interest rates are going up. And interest rates are going up and inflation is on the rise, which means the borrowing rate that you use in a lease most likely needs to be determined and will be significant or material to the outcome. A couple of years ago, when leasing started, 2019, for example, I think we were dealing with lease discount rates in leasing that might have been down to like 1 or 2%, depending on who you were. It almost didn't have an impact on the discounting. Now we're up to sort of 7, 9, and sometimes 10% for some property leases, depending on the environment and so forth. What's the theory behind it quickly? The theory behind it is, can the interest rate be determined implicitly from the lease? And the answer is yes, often for motor vehicle finance, because often you know what the rate is implicit in those. But most leases, especially the property leases, the answer is no. And the no then means you actually have to work out an incremental borrowing rate, which is the discount rate that you use, one of the inputs that feeds into your lease liability calculation. Why is it a challenge at this time of the year? It's a challenge at this time of the year because you're probably going to need valuation expertise for some, if not all, of your leases, depending on the nature of the lease, the complexity and significance. So what is the lessee's incremental borrowing rate? Well, just here's some theory again. It's the rate of interest that a lessee would have to pay to borrow over a similar term with a similar security. So normally that means the security is property when you come to a property lease, and it deals with the funds necessary to obtain an asset of similar value in a similar economic environment. In other words, a property lease of 5 years in Australia will have a different incremental borrowing rate to a property lease of 10 years in the United States, because their economic environment different, their lease term is different, and if you had a 10 or 5 year motor vehicle lease in those two jurisdictions, it would be different because the nature of the asset is different. All of those things come together. The most common challenge we have is a lot of organizations, and I was actually astounded at how many organizations did this. Back in the days when we adopted leasing in 2019, we used either the borrowing rate or the bank overdraft rate of the company because it was so low that it almost didn't have an impact on lease accounting. Now we've realized that when we're working out the incremental borrowing rate for some of our clients, they weren't aware that the incremental borrowing rate that gets used is a formal valuation that is specific to the term, security, and economic environment of the lease. And it really only uses the borrowings of the company as one of the inputs to get to the incremental borrowing rate. Lots of organizations we're dealing with are coming to us and saying, how do I work out my incremental borrowing rate? And the answer we're giving them is, if you don't have the skills to do it, it's actually a formal valuation that our corporate finance team can do. And they will use something similar to this model, where they start with the base rate in an economic environment, add financing factors and asset-specific factors. And for unlisted entities, or really any entity that doesn't actually have formal borrowings with a bank that has a similar term, what they're actually doing is working out a credit rating from similar companies and adding a credit spread onto that. It's a formal valuation report. It's often 10 to 11 pages long, and each lease often has its own valuation depending on what you're doing. So the challenge here is getting on top of this quickly, making sure you've got the skills and the capability to do this, making sure you have access to a valuation specialist if you need to, understanding that it's a per lease determination. So each lease in your portfolio might need this, depending on whether you need an incremental borrowing rate, and we'll cover that later on. And also understanding what your auditors want, because some auditors are actually expressly requiring a formal valuation report to work out the incremental borrowing rate on some leases, depending on their materiality and significance. So that's my thing. Aletta, any comments from your side on that?
Yes, so the big issue that we've seen is because, so in the past, from 2019, for many years, we had a very stable interest rate environment. And therefore, many entities have acknowledged that, yes, we need a new IBR for new leases. And when we modify leases, or when leases go in holdover and we sign modified agreements, we need new incremental borrowing rates. But a lot of entities have said, listen, we've established an IBR and paid the valuation expert for an IBR in 1 July 2019, when we first implemented. Interest rate environment hasn't really changed. So to have a new IBR is neither here nor there, won't have a material impact. And I think many auditors have accepted that approach. However, what we've seen now over the last number of months, we've had an interest rate increase more or less every month. And therefore, that approach, which your auditor might have accepted in the past, they will no longer accept. Because an IBR of 3% might now be a new IBR of 7%, right?
That's right.
And the whole economic environment is now changed. So what we've seen is many clients have just pushed ahead with their original IBRs and failed to update new leases with updated IBRs and modified leases with updated IBRs. The impact is really material. And what happens is, if you've got this higher incremental borrowing rate, your lease liability would be lower, but what would be higher going forward is that interest expense, right? And you increase, and the other thing, so you, in a high interest rate environment, we expect a higher interest expense. But that's in the P&L, right? And that's why people worry about it. The other thing that happens in an high interest rate environment is where we start with the right of use asset and the lease liability being the same, whether it's low or high interest rate environment, doesn't matter. But going forward, in a high interest rate environment, the repayment and the capital portion of your lease liability that is reducing every year is quite low, because most of your payment is interest expense.
Right.
So very quickly in your balance sheet, your lease liability is much bigger than your right of use asset, because the right of use asset is depreciated evenly over the useful life, and the liability doesn't really move because we pay so much interest. So there are impacts on the balance sheet, material impacts, and there's material impacts on the P&L. And I think entities have to be ready for the auditors asking some questions around IBR.
And also, Aletta, I think it's a good point, because management need to understand what this is going to do to their balance sheet. A number of organizations I know of who've left leasing to the finance team or the financial controllers to run with have now been surprised that suddenly their balance sheet at year end looks completely different to what they thought, because the impact of the discount rate on the lease liability, and more importantly, what that's done to their finance cost and charges, especially when you're at the beginning of lease terms. It's had a material impact from a strategic point of view, and that flows into everything: impairment, non-current assets, meeting covenants. It kind of has this knock-on effect. So you want to make sure you understand what the impact of this is. When does it impact? And I think on the next slide, we actually make the point, also understanding when you need a new incremental borrowing rate. You don't need a new incremental borrowing rate every year for every lease. Now, we'll come back to this later in the presentation. We've got a slide on it, but the new updated IBR really only you need it in certain circumstances, most normally associated with actually renegotiate a contract. That's a short way of thinking about it. Every time you renegotiate a contract and sign a new agreement, let's say, or renegotiate terms, that's a reprice event almost, and you would need a new IBR. So even scenarios where you have a lease that was negotiated, that's, let's say, a 10-year lease, and you might be, in year 5 now, might have a very low incremental borrowing rate, because when you started accounting for it, it was a long time ago, interest rates were low. You suddenly renegotiate this year a change in terms, and that change in terms and that renegotiation reprices the contract, and suddenly you jump up to the new IBR, because the IBRs are much higher now. So something to really focus on is to get your head around this. And the other thing is to actually just come up with ways to manage this. Some organizations actually have a reprice event on a contract every month. And so what they do is they actually have a new IBR every month that they're calculating, and they've got their audit or their evaluation experts to help them put together sort of a mechanism to come up with, let's say, a monthly IBR that gets used for leases depending on terms. But other organizations just get an IBR from the evaluation expert depending on when they need one. It's gearing up for that and making sure you've got it at the right time. I think we've probably covered that one.
Yeah, I think in the past some entities would update their IBR on a quarterly basis, and because the environment's quite stable, they would use the updated IBR for all new or modified leases in the next 3 months. But at the rate it's going now, you actually need to update it more regularly, potentially. And I think it comes back to your point around project management, and the fact that things change and we have to be agile. I know a lot of entities treat lease accounting as a top side adjustment at the end of the year. But that doesn't mean that you don't have to do an IBR every month, or you don't have to manage your data on a monthly basis, because you can get some nasty surprises in this topside journal at the end of the year.
All right. Flowing on from that thought, before we jump into holdover leases, is actually just an observation that I've had, Aletta, that a lot of organizations who've previously treated lease accounting as a topside adjustment have started to realize that that's not working for them. And so it is interesting that I think we're starting to hit that precipice where most organizations now, or at least, you know, serious ones who have got large balance sheets with investors or banks or whatever, are actually starting to recognize this now as a serious system and process adjustment. And so they're actually moving to maintaining this on a monthly basis. They're moving away from Excel, they're getting a proper system in place, they're getting proper software. That is starting to happen. And we're also starting to see a request for forecast information, because it's starting to feed into budgets and forecasts now, because it's a high inflation, high interest rate environment where this does actually end up having a big impact on those numbers at the end of the year. So it is an interesting observation, and that's maybe just something for our listeners to take away and start to think about. Right, let's jump into holdover leases. I don't know if this is my favorite topic or my least favorite topic, but it is certainly one of the practical challenges we run into. It first came up really strong in the public sector and not-for-profit sector, where leases tend to go from the non-cancelable period and kind of drop into a month-to-month type arrangement. So that we call that holdover. But it comes back to the principle that in lease accounting, the lease term comprises the non-cancelable period. So often if you enter into a lease, and let's say it's a 2-year lease, that's the non-cancelable period. But then there are rights in the contract that allow you to either exercise an option or allow the lease to kind of drop into a holdover period beyond that non-cancelable period. And those periods actually do need to be taken into account as well in the lease term, because the lease contract has rights that allow you to essentially hold on to the asset for use beyond the non-cancelable period. So periods covered by an option to extend, if the lessee is reasonably certain to exercise that option, management decision or management judgment, as well as periods covered by any option to terminate, where the lessee is reasonably not certain to exercise that option. Pretty much what we're saying is, you need a legal expert, or you need to legally sit down, understand what your rights are in the contract, and work out what is the reasonably certain period I'm going to actually occupy this property in accordance with the rights embedded in the agreement. And that includes including the rights to exercise options to extend, which could include the right to enter into a month-to-month contract afterwards, essentially rolling. That needs to be taken into account in your lease term consideration. Now, it's not a new topic, and I think on the next slide we've got a wonderful diagram. As you know, Aletta actually loves a decision tree. Like, give Aletta a decision tree, she's all over it. And I think, Aletta, you might have come up with this one. I can't remember. I think this might have been your work.
I can't claim this one. BDO Global did this one, but it's a beauty. I wish I could claim it, Karen.
It's a beauty. I think you claimed it for your own then, because it was a nice decision tree. But what it actually tries to demonstrate is that the lease term is essentially driven by the rights embedded in the contract, and specifically the rights that lessees might have by themselves, lessors might have by themselves, or if both party, lessor and lessee, can terminate the lease. This is a very good diagram to use, especially if you've got holdover leases. So that's the topic we're dealing with under this challenge, holdover leases. So holdover leases are really who has the right to enter into the holdover period. In other words, let's say the month-to-month period. And often, for simplicity today, I'm just going to focus on the most common form we find, which is the one where either the lessee can do it or both parties have the right to, essentially. In other words, you're in a month-to-month part of the contract, and both parties really can exercise that right. The practical problems here is, first of all, understanding who's got those rights, reading the contract, understanding its terms. But second of all, then is establishing, especially when both parties have the right, to determine essentially whether either party might or might not exercise that option based on the facts and circumstances of whether there's more than an insignificant penalty associated. What do we mean by that? And I'm just going to give you a simple example. If I'm leasing a property from Aletta and I've got the right to essentially keep going on a month-to-month basis, but I've actually significantly modified the property I'm in by, doing significant leasehold alterations or leasehold improvements, most likely I'm not going to want to leave that lease because I'm going to lose the investment of the leasehold improvements. That's a significant penalty to me. It doesn't have to only be a financial penalty. It can also be by the fact that I'll be walking away from a premises that has been modified to fit my business purposes. I'm most likely not going to cancel that lease anytime soon, even though it's in month to month, because the cost of me going to find out the premises is just too big. And these are some of the conditions that are used to determine that. The reality of it is I'm not going to be in that lease on a month-to-month basis. I'm going to be in that lease at least as long as those leasehold improvements are important to me. So my lease term might be an estimate of 3 or 5 years, because I intend to keep reviewing on a month-to-month basis to stay in there until the benefit of those leasehold improvements come back to me. The lease term in that scenario is 5 years or 3 years. It's not month to month. It's not a short-term lease, and it should be on balance sheet with the lease term included. This is very common at the moment because lots of people are in properties that I want to leave. If you haven't noticed looking outside the building, leasing or access to property is becoming harder and harder in some sectors, mostly residential, but it is also in commercial. The way we do business is changing, and people are trying to use their ability to stay in premises, even though they might be in a month-to-month lease while they're busy renegotiating it or whatever. But the reality is they've got the right to do it and they don't intend to leave. Their lease term is clearly longer than the month-to-month arrangement. It might be 3, 5, or even 10 years, depending on the facts and circumstances. And that should be put on balance sheet with that longer lease term. Aletta, I think you might have a couple comments here as well.
Yes, I think one has to remember that this was actually an IFRIC, Interpretations Committee decision, because initially a lot of people said, if I've got a month-to-month lease, it's a short-term lease, I don't have to apply IFRS 16 beauty. And the IFRIC said, hang on, it's not just your legal arrangements, it is penalties, and penalties are not just economic penalties. It doesn't have to be in the contract. So we are saying reasonably, what is the expected period that you will be staying in the property? So to me, it's a little bit of an anti-avoidance measure that you can't avoid that we have in tax, right? You can't avoid IFRS 16 by entering into these month-to-month leases. I think where we're finding this quite problematic is where entities have a 5-year lease, and at the end of the 5 years, property automatically becomes a month-to-month lease in Australia. And then entities have this 5-year lease, and they've applied IFRS 16, all good, and after the 5 years, they do nothing. Once you get towards the end of the initial 5 years, you have to start to think, will we move to a new property? Will we try and stay here? Will we renegotiate? And you have to estimate. So although you're still busy negotiating a new lease, the fact that it's your intention to stay there because it's a great location and you've got a lot of fit out, you already have to estimate expected lease term, you have to estimate expected lease payments, and you have to book it before 30 June, right? So you don't have a new agreement yet, but that holdover aspect says, please estimate. And a lot of people forget to do that. And it's got a big impact on financials.
Actually, Aletta, that scenario you've just mentioned is actually our next example. So maybe we'll just jump to the next practical, which is renegotiations of holdover. Look at that. And there's actually an example that we put in. Aletta actually put this one in, so we'll bring it up. This is the one that Aletta is talking about, and we do see this very often. Let's go through it as a fact pattern. 10-year lease of a building expires May 2023, just before year end, of course, because it makes it nice and complicated. From 1 June 23, the lease is in holdover and the entity is busy negotiating a new lease. And let's say their estimate is they're going to be there for another 3 years and the expected lease payments are $8,000 per month. Aletta's point, which is true, is that you're already in holdover you already have the right to keep being in holdover. You would need to look at who's got the right to evict, the lessor or the lessee. So it comes back to the decision tree we had a few slides back. But let's assume we're in a standard holdover where neither party, where both parties have a significant penalty if they want to cancel this. So it's actually in both parties' interest to keep negotiating and to stay on. Well, the lessee in that scenario would estimate before their year end, let's say at least term of 3 years, and bring that on balance sheet by year end. In other words, they won't treat this as a month-to-month lease. Before the lease expired in May 2023, they probably would have done a reassessment, which would have brought a new lease term on balance sheet for that lease, and by the way, a new incremental borrowing rate, because they're essentially repricing their lease term. And that all would have happened before June. And how would you have known this? Because you would have project managed your property management team to find out from your property management team who's doing what, which ones are we negotiating, and you would have had to make estimates and judgments about actually bringing that lease back on. And guess what? On the 1st of August, you actually did enter into a brand new lease, and you have another adjustment at that point because you had previously estimated a 3-year lease. So by the 1st of August, when you finally sign the new lease agreement, you'd actually have to re-estimate it now to a 5-year lease with a $10,000 per month, and again, a new incremental borrowing rate because you've repriced it again. So the lease would never leave your balance sheet. It would be there almost like a balloon that you're bouncing up. You'd keep it going because it's on balance sheet. And by the way, that's not a new lease under lease accounting rules on 1 August. It's a modification on 1 August to an existing lease, even though there's a new contract, because the underlying asset is still the same, which is the same building. So modification to an existing lease, even though the new lease agreement is a contractually new lease agreement. Now we're going to step it up because we've got 15 minutes to go, and those are our sort of our key ones. I want to say, Aletta, can you take us through this one? I feel like you're best placed to talk to your decision tree again on managing ongoing changes to the lease portfolio.
So, Kevin, this decision tree I can genuinely claim.
No.
So the other one is BDO Global. This one is one that I've come up with. And when we look at ongoing changes, we've categorized 4 types of changes that can happen. You could have a genuine new lease. So this is a new lease for a new property, a new vehicle that you haven't previously used, right? So it's a brand new lease. Okay, we apply IFRS 16 fairly easy. Or the second category in blue is we've got remeasurements or reassessments of existing leases. Now, it could be that there is a change in the way we assess whether we'll use extension options or not, or termination options. It could be a change in residual guarantee. It could be a change in CPI, or it could be market reviews. And all of those, we would say, is a reassessment. And we wouldn't expect a P&L impact. What I mean by that is, if the lease, you work out the lease liability first, the impact on the lease liability. If the lease liability is increasing, then you'll also increase your right of use asset, or vice versa. So there's nothing going to P&L normally. Around discount rates, if you change the term of a lease, then you have to assess a new IBR. If the term of the lease stays the same, but CPI changes or residual value changes in an existing lease, and it was already factored into the original lease agreement, you won't adjust the IBR. Now, the third one is usually the very difficult one, and that's a modification of an existing lease. And you have to read existing lease quite wide. We're not talking of an existing lease agreement. It is the existing use of a property, as Kevin just explained. So you could have had a lease agreement for a property, and now you have a brand new lease agreement for using exactly the same property. So that's a modification because you're just continuing to use the same asset. And now we consider, do we book that as a separate lease, or is it part of one item? Here it really depends on whether there's an increase in the scope. Are we adding a new asset or a new floor to the building, for example? And the other aspect, which is critical, is whether what we pay for that new floor in the building is at a standalone price. Often, when we modify a lease and we add another building, or we add another vehicle, or we add another floor, there's some kind of consideration that you get some kind of better price because you're already a tenant in the building, or you already lease a number of buildings. So in that case, it's not treated as a separate lease. So to have a separate lease, you need a consideration that's a standalone price. If it's not a separate lease, again, it depends on whether you have a decrease in scope or not. If it's a decrease in scope, so it is a smaller property that you're now leasing, or a shorter lease term, it's a two-step process, a new discount rate, and you can expect an impact on P&L. And all the other modifications, obviously you update your discount rate, but usually no P&L impact. And then the last one is termination of leases. I just want to make clear, and I know we discuss it later on, a termination of a lease is an early termination of a lease. It's not an expiry of a lease. Expiry of a lease is the natural conclusion of a lease. A termination of a lease is where before the end of the original lease term, you decide to exit, and then there will be a P&L impact. Because your lease liability and your right of use asset will sit in your balance sheet at different values, to remove those will give you a P&L impact. And depending on where you are on the journey or the lease term, it could be a gain or a loss in your P&L. So it's really important to understand what type of change we have. And in this diagram, we try to highlight two things. One is whether you stick with the original IBR or whether you have to update your IBR. And the diagram can be used to assess that. But the diagram can also be used to guide your expectation on what you expect to happen in the P&L. When do we expect to see something in P&L, and when do we just expect to see an adjustment in the balance sheet? For me, I always like to look at high level, what do I expect to happen? And then when I get to the journal entry, does it line up with my high level expectation? It's like a test to see that I'm doing the right thing. I know our lease accounting team spend a lot of time looking at this diagram. I think it really makes the process very easy. Kevin, over to you.
The diagram, thank you, Aletta. The diagram is useful. I have seen some variations of it along the way. I think there's clients and non-clients who use it because it's actually so out there in the market. And some of them actually have used that to design their processes internally around those. So different parts of the business know that if they've got a new lease, then they've got to, at that point, it triggers a new discount rate. So they get the valuation guys in. The property management teams know that if they're actually entering in a new negotiation, that it's going to have an impact. And so they notify the finance team and everybody gets on board. So the point really at this point is to just remind you that the challenge is to essentially bring this all together like a nice system that's humming nicely, all the different parts coming together all at the same time. And the CPI adjustment is another one where you want to get it humming. It's a simple one. And on a very basic level with CPI adjustments, we don't take CPI adjustments in really until the index or rate is remeasured when we know what it is. So at the initial recognition of a lease that has a CPI adjustment in, we use the rate or index at commencement date, and then we essentially remeasure as that rate or index rises. So if there's a CPI increase on the 1st of January each year, then on the 1st of January, you'll have a remeasurement in your lease calculation. The practical challenge is actually understanding what that number is, because often what happens in practice is that a CPI adjustment might happen on, like I said, 1 January each year, but actually it's only in April or May or June that CPI increase comes through on the invoice from the lessor. And so the finance team is already a couple of months behind on what the number is. But that doesn't negate the fact that if the index is known and the remeasurement date has happened, you need a process to essentially integrate that into your accounting, because reasonable certainty or certainty about what the index is and the impact on the remeasurement on the date that it applies to may mean that you've already got a remeasurement date, even if your finance team is coming up behind it only a couple of months later with the actual number. And you've got to figure out a way to integrate that and to essentially bring it in. So that's the one challenge with CPI adjustments, is to make sure that your finance team are on top of that, and there's good communication with the property management team so that they can account for that remeasurement when the information is available on the remeasurement date. Jumping through some of the other ones.
I think important here is to flag the difference between a fixed increase and a CPI adjustment. So if your contract has a starting payment and there's a fixed increase of 3% every year, you factor all of that in your calculation of your lease liability on day one. And CPI is the opposite. You wait until you know.
Yeah. So this one is, we've already covered this, so we'll just knock it off. Practical challenge number 6, new leases, which are actually modifications. As we've said previously, oops, I've just lost my light. New lease agreement, new legal agreements does not mean that you have a new lease under accounting standards. If you have a continuation with the same asset and the negotiations or the adjustment is with the same lessor or the counterparty, what's really happened in practice or in reality or in substance is that it's a modification to the right to use that asset because the asset hasn't changed, and that is accounted for as a modification under lease accounting, not as a new lease. Very different answers between the two, although they both require new discount rates because there's a new agreement that has to be repriced. But under a new lease agreement, you'll have a, let's say, simplistically, the right of use asset will equal the lease liability, whereas on a lease modification, the right of use asset and the lease liability won't equal each other on the modification and probably won't equal each other after the modification because you're just continuing to depreciate the right of use asset that was already on balance sheet. Big difference. Can have a massive impact on your numbers, and so it's important to get that one right.
Kevin, the other one that we've seen here, if people already have a lease and then they replace it with a new lease agreement, some people have terminated the original lease and have some P&L impact, and then they processed a new lease.
Yeah.
Where if you treated the new lease as a continuation of the original lease, the timing that you process all of this is different, and it has a different impact on your P&L, right? Because you will only have a P&L impact on a modification if there's a reduction in scope. So you have to be very careful here. You don't have an original lease that you terminate. No, you're replacing an original lease with a new lease. You're basically just modifying it. And the fact that it's written on different pieces of paper is irrelevant. So it really is substance over form.
And I like that point, Aletta. It's a really important point about your profit and loss impact is the earlier or the further the sooner you renegotiate a lease before its eventual termination or expiry or coming to an end, the bigger the profit and loss impact if you get it wrong.
Yeah.
And so you really need to be on top of that. It's not structuring, it's not an anti-avoidance provision, it's just trying to represent the substance that the cost of the asset isn't a P&L impact, it's essentially just a change in the right of use asset on balance sheet. Expired leases is what Aletta mentioned earlier, so we can cover this one off relatively quickly too. The end of the lease term, the lease essentially comes to an end. The asset and right of use asset and lease liability should run out. But this one, and actually this is probably Aletta's story more than it is mine, because Aletta at some point a couple of years ago realized that if you don't remove the original cost of your right of use asset and the from your, let's say, your asset register, the asset and the accumulated depreciation sit there forever, and that can have untold consequences for not only reporting, but essentially adjustments later on a commercial basis. I don't know if you want to add to that, Aletta, because it was your experience that we ran into that one.
Yeah, I think it is interesting. It's so easy to just say, listen, we're at the end of the lease. We no longer have payments. We've done everything and we just stop. But it's that extra step of removing the asset, removing the accumulated depreciation, taking it out of your lease register, your asset register, because you're actually inflating your balance sheet, grossing up the balance sheet. And I know on a net level it's zero, but it looks as if you've got a lot of assets, especially if it's thrown in with a bunch of others. Yeah, so that was an interesting one.
I had seen that as an analyst question in a listed company before. They wondered why there were so many leases on the balance sheet that were fully depreciated, and it kind of became messy, and that was just pure procedure they forgot to take that out, and you know, inflated gross and on both sides. Early terminated leases is the fun one. This is what we call a termination in lease accounting. Aletta's made mention of it before. I want to say the easy answer here is to expect P&L impact, because you're essentially negotiating and modifying the lease to terminate it early. That's actually what's happening. I've been in technical debates on this one, because the reality of it is, if you're early terminating a lease, and essentially, especially if it's in the non-cancelable period, in other words, you signed up for a 3-year lease and now you're terminating it year 2, you'll have 1 year to go on the balance sheet. But what you're actually doing is modifying it first and foremost, and the modification is a termination. So you are essentially you know, taking 2 steps there. Now, most organizations won't process it as a modification and then a termination, but the reality is that is what's happening. So you should expect a P&L impact because of the termination side, but you will have some changes depending on how the scopes change and how they vary. This is different to a lease just running out. And it's important that your accounting department understand the difference between the two. Early termination actually has real consequences because it's a commercial event that needs to be reflected, and that will often lead to a P&L impact in your profit and loss. And I think then Aletta, on the make good provisions, I want to say this one is actually this one, the last 2 we can cover relatively quickly, but they actually have major impacts. Most organizations have started to realize that there are make good provisions associated with most of their property. We didn't see it much in the transition. A lot of our clients, we used to question it, but they didn't actually recognize the provision. Now that's coming back to them, especially with costs going up. Landlords are enforcing make goods, and you know, cost of putting back our properties to the way it used to be on entry. But the make good provision is actually arises from the provision standard, IAS 37 or AASB 137, but it actually impacts the right of use asset on initial recognition and therefore impacts the depreciation. And then it can get really exciting at that point, because the liability, being the lease liability, and the provision liability are actually 2 separate liabilities governed by 2 separate accounting standards, often with their own discount rate. But they interact each other through the right of use asset in most cases. And one of the easiest ways to see this is if you recognize a make good provision on initial recognition of a lease, it will go to the debit side of that provision, will go to the right of use asset. The unwinding of the discount on the provision doesn't go to the right of use asset, it goes through to finance cost in P&L. But if you re-estimate your make good provision at some point during the lease term, the re-estimation will once again impact the right of use asset and essentially impact future depreciation. Very complicated. Essentially, you essentially need to maintain 2 liability calculations here with 2 lease liabilities, and clearly understand how changes or edits to the make good provision interact with the right of use asset, what dates and what part of it interacts, because you've essentially got a provision that might be measured in real and nominal amounts, and depending on how you're measuring your liability could impact the way it impacts your right of use assets depending on your re-estimations. I want to say that this by itself is a specialism, and if you don't know what to do with that, seek some help specifically on that before your year end or before finalizing your numbers. Can have very real impacts. Finally, on subleases, it's a practical challenge. Subleases, essentially when you've got a head lease and then you've sublet part or all of the asset underneath, you're essentially subleasing the right of use asset. So the right of use asset, you either have sublet it under a finance lease because you've essentially handed it over to the subtenant, or under an operating lease, and you need to compare in substance how much or to what extent you've sublet the property to determine whether all you've actually done is pass through the lease to the subtenant, which is a finance lease, or whether you've retained some degree of control of the risk and rewards as an operating lease. Under financing lease, you've actually de-recognized the right of use asset because you've sublet it completely, and all you've got in its place is a lease receivable from the tenant. Under an operating lease, you've still got the right of use asset on your balance sheet, but you've got lease income on a straight line basis through profit and loss. This has become quite problematic because suddenly with the change in rentals and tenancy laws and so forth, there's a lot of activity happening in the market where people can't get out of the leases they're in, so they're suddenly subleasing, and they forget that the right of use asset may have to be derecognized in favor of a lease receivable, or if that's a finance lease, or under an operating lease, you might actually just have a straight line. Both of them, you keep the lease liability because the head lease is yours. And the other thing I've seen, which is an extension of this, not quite an extension, but it's another practicality which I have seen arise quite recently, is we're suddenly seeing a lot of sale and leasebacks coming. It's not quite this topic, but it is also an economic driver of, I would like to get some cash out of this property. I'm going to sell the property and lease it back. How do I account for that? And that complexity can have real ramifications, not only for the capital balance sheet, but also for how you recognize the gain and loss on disposal. Because you haven't actually sold the asset in its entirety, you've only sold the ownership of the asset. You've retained the right to use the asset, and that can actually impact the gain or loss on the disposal in the year of the sale and lease back, and there's some complications there. So this one I'm going to end with by saying it's actually quite complex. There's a lot of IFRS judgment there, and I think if you need to get some assistance there, get it sooner rather than later, before you enter into the sale and lease back or the subtenant lease agreement, just to understand the impact on the balance sheet. Now we've gone over a little bit, so I'm going to hand back to Aletta to round us out for.
Thank you very much, Kevin. I hope that our attendees have found that useful. We've really tried to come back with the practical things we see in our audit client base, but also our advisory client base. And these are real stories, and it hasn't happened once, but multiple times. Where do we get all these stories from? As you know, we license a software technology to Video Lead, which is software as a service, but we also have a team that does outsourced lease accounting for a large number of clients. So they encounter these difficulties, and I've asked them, please give me examples of the problems that you're finding, maybe misconceptions out there. So if you're interested in Video Lead software as a service, please feel free to reach out. Or if you want to outsource your lease accounting to us, where we use Video Lead to do everything, please contact us again. And the outsourcing is a monthly process. It could be a quarterly process, half yearly or annually, where you provide the data to us, we process the changes, and we give you all your reports and deal with the auditors. Finally, if you need assistance with your 30 June financials or otherwise, we've got some core sustainability services, helping with measurement of the carbon footprint, helping with sustainability reporting, TCFD recommendations, the new ISSB standards. We can also help you with a decarbonization strategy or a sustainability strategy or roadmap. And finally, assurance over carbon footprint or sustainability reporting. So can we help you with that carbon footprint? Maybe we should start with scope 1, scope 2. Please reach out. Can we help with that TCFD disclosures? Again, please reach out. I know Corporate Reporting Insights for July is going out tomorrow. I've recorded the video earlier this morning, and you can register for Corporate Reporting Insights or our Sustainability Insights that go out every month. Our ESG webinar series is continuing from next week, and we're focusing on carbon footprint over the next 6 months, and there's a TCFD e-course for you. If you're looking for sustainability information or IFRS information, obviously always on our website. These are the key contacts for sustainability across the various locations, and these are the key contacts for IFRS and corporate reporting. And this is our broader team, and a lot of this team actually does outsourced lease accounting. I'm thinking Julie, Christine, Tom, Annelie, Lizette, Nolene, Anita, all do lease accounting, basically on a nearly full-time basis. So please feel free to reach out, and we would love to help you. Kevin, thank you very much. I'm now off to a sustainability conference, and we'll speak soon. Thank you, everybody, for attending.
Goodbye.